Hi friend, welcome back to my channel. Those who are absolutely new in my channel, please subscribe my channel and hit the bell icon just beside the subscribe button. Today I am going to discuss about the gap insurance part 2. How gap insurance works. It is fairly easy to a driver to owe the lender or the leasing company more than the car is worth in its early years. A small down payment and a long loan or lease period are enough to do it, at least until your monthly payment add up to sufficient equity in the vehicle. In terms of filing claims and vehicle valuations, equity must equal the current value of the car. That value, not the price you paid, is what your regular insurance will pay if the car is wrecked. The problem is that cars depreciate quickly during their first couple of years on the road. In fact, the average automobile loses 10% of its value in just first month after purchasing it. If your vehicle is wrecked, your policy won't pay the cost of replacing the car with a brand new vehicle. You will get a check for what a car comparable to yours would sell for an used car lot. Insurer call this the vehicle actual cash value. Gap insurance doesn't cover that particular gap. The payouts are based on actual cash value, not replacement value, which can help to minimize financial losses to you. Car gap insurance example. Say you purchased a new car with a sticker price $28. You paid 10% down, bringing your loan cost down to $25,200. You got a 5 years auto loan. For the sake of simplicity, let's say you scored one of these 0% new car financing deals. So your monthly payment for $420. After 12 months, you have paid $5,040. You still owe $20,160. 1 year later, the car is wrecked and the insurance company writes it off as total loss. According to your auto insurance policy, you are owed the full current value of the vehicle. Like the average car, your car is now owed 20% less than you paid for it a year ago. That's $22,400. Your collision coverage will reimburse you enough to cover the outstanding balance on your car loan and leave you $2,240 to put down on a replacement vehicle. But what if your car was one of the model that don't hold their value as well? For instance, say it's depreciated by 30% since you purchased it. In that case, your insurance check will be $19,600. You owe your lender $560 and you still need a new car, which is where having car gap insurance becomes important. Do you need car insurance? You may have heard term upside down in reference to a home mortgage debt. The concept is the same where the item financed is a house or a car. The thing financed is currently worth less than the balance of the loan taken out to acquire it. This isn't as dire as it sounds. If you put only a little money down on the purchase and pay the rest in small monthly installments spread over 5 years or more, you don't immediately own much of the that house or car free and clear. As you pay down the principal, your ownership share expands and your debts shrink. Gap insurance is needed to cover the shortfall, so you are not on the hook if the car is wrecked.